Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with my good friend Doug Hagren. Hey, Doug.
Morning, Kirk. I want to remind everybody that and clarify that Kirk said we're live. He didn't say we're alive. It is still Monday, and I'm sure all of you feel half dead, like walking zombies. But we're here to stimulate you and bring you into the new week with a bang. So, good morning.
Yes, whether I'm alive is questionable. Just coming off a weekend of I don't know what you call it, allergies or being sick, but definitely feeling a little rough this morning, Doug.
Kirk, I don't know if you're hiking. I was reading this morning. They're talking about all the boom of diseases that are coming out. COVID's over. Although I did see an article, they've been testing the wastewater in New York, and they said there's been a huge spike of COVID that nobody knows about, but it's in the waste. So just so you know. But they
Well, we
said
should all be afraid then.
they should all be afraid that clearly there's a huge spike in COVID that nobody knows, nobody's getting sick from, but it's there. Now, on top of that, I was reading like all these new diseases like RSV and all these things are coming out, and now they're talking about a new virus. I think they haven't even named that isn't exist that they're not sure of. Sorry, not to get political, but they did say that I guess there is a boom of there's another tick-borne virus that is spiked up and like it always does. Where's Lyme disease from? The Northeast. So in your neck of the woods, maybe, if you're going out there hiking, make sure you've got your permethrin and your bug repellent, because, who knows, maybe you've just been a tick buffet for the weekend. You didn't know it, Kirk, because I know you're an outdoors kind of guy.
Well, you can't officially say that Lyme disease came from New England, Doug. I don't think we truly know where that came from.
Well, it's named after it, Kirk. So you know what? Well, I mean, I'm sorry. It's offensive probably to call it Lyme's disease. We should just call it the tick virus, because you don't want to name a virus from the region it came from, Kirk. That's offensive.
Or a town, actually. But
Yes,
who's judging?
Yeah.
I think let's start off this week because I think we just had the debt ceiling vote, and it finally passed, and it passed just like we said it would, with not a lot of ruckus. Not a lot happened, and the markets knew that. The markets definitely knew that, because the markets were not budging from the debt ceiling. Nobody cared. There was no sell-off. There was no default. There was no trillion-dollar platinum coin, created from the Treasury to solve problems. Good old-fashioned Republicans and Democrats getting together and hatching out a really crappy deal for all parties. It was a win on all sides, Doug.
I don't want to. It was equally happy and equally pissed. That's the perfect bipartisan. I actually I was looking for a bullhorn or something around here, because I think the official term for that is the markets didn't give a beep
Yes.
about it at all, because it was so much political crap. I mean, I don't know if you heard. I talked about this last week. I said they're going to be pushing through spending caps. As a matter of fact, they're going to be pushing through spending cuts. And they did, Kirk, according to the government. Supposedly over $1 trillion in spending cuts are going to be happening over the next decade, I believe. Although, when you look at the numbers of spending are going up. So again, once again, I think of the 7 most dangerous words, or whatever the most dangerous words are. Hi, I'm from the government. I'm here to help. Once again, the government has come out here to say, look, we're cutting spending. But when you look at the numbers are rising. So I'm not sure how they spin this. It is it's just, at this point, it's just a joke how easily they can spew crap out of their mouth. But supposedly there is spending cuts in there somewhere, I guess.
Well, there was one point that I heard. I didn't read the whole thing because naturally it's just a pile of crap. But just like most other things that pass. But basically, one thing that was pointed out was that they use the baseline for their numbers as the peak spending in COVID. That was their baseline of what they use. They're like, we're not going to raise it past this. I'm like, yes, with the highest baseline you can imagine. We spend all this money, and here's the base. I mean, the absurdity. This is why I don't spend too much time in politics, because everybody gets all riled up, and for what? Just a pile of crap's going to pass through regardless, and people are going to. I mean, look, the politicians get elected and they want to get reelected, so they're going to do whatever they can to make themselves look good, and that's what this whole debt ceiling was about: was getting attention on them. It had nothing to do with the people. It had nothing to do with anything else. It had to do with them trying to make a big deal of it. The whole point of, oh, we're going to default on our debt if we don't pass this. BS. Total BS. Last time it was, hey, we can't pay our employees. And then they found out nobody gave a crap, right? Nobody gave a crap about paying government employees. And it has nothing to do with government employees. All right. I know there's some that listen to the show. It has nothing to do with you. It has to do with the fact that the government is always trying to find some hot button that they can push our buttons to move things along by riling people up. That's all it is. So this time they said, we're going to default. And everybody's like, no, you're not. That's like the worst bluff I've ever seen. It's like bluffing in poker, but having your cards turned around so everybody can see them. I mean, that's basically what they were doing.
There is a casino, Kirk, that I believe, I don't know if they still do it. I think Ellis Island Casino in Vegas does face-up blackjack, where the dealer where you can see the dealer's cards. And amazingly, people still lose. But there are some versions of that out there.
Well, that actually, I would pay to watch that. That seems to be interesting. I mean, the odds are still in the favor of the house, but still, that would be an interesting game. Maybe that's for the people who are cognitively challenged. We can't call them that because that would offend people who are cognitively challenged. But no, let me reframe that. Statistically challenged, Doug. They are statistically challenged. All right, so I don't know, Doug. What's in this pile of crap? Is there anything worth talking about, or should we just move on?
Well, I think there's a couple things we can go. I mean, obviously, Republicans wanted more static funding, which they got. The Democrats wanted a 7% increase in spending. They agreed on some defense that obviously, they were looking at more than 20% the Republicans want. This is all crap. It's just the negotiating stuff. One thing I know we had talked about the IRS. There was an $80 billion IRS windfall that they got to, through the Inflation Reduction Act. They're going to rescind, 21 billion of that back. So there's going to be less money going to the IRS to ramp up. Although this is one of the things I think it's important to know, only 1.4 billion is rescinded immediately. So there's still a concession there to allow a massive increase in hiring to the IRS, but they're also agreeing to redirect an additional 10 billion from the IRS to other federal agencies. So I don't, Kirk, I want to argue with you on that. You say this wasn't being in the best interest of the government and employees. I think it is, because by the end of the day, everybody's going to be a government employee. So long term, I think this is in the best. They are speaking to where everybody's going to eventually work. Other than that, there's work requirements for federal food aid, big time there. There was also some agreement on environmental. I think what they really, really wanted to try to get through there was increased legislation around the environmental. So the deal, the federal government, Republicans got 1 to 2 year time limits for environmental reviews of new projects. So after that's like a statute of limitations. The number of pages an agency's environmental analysis allows developers to go to court to sue if the agencies miss the deadline. But on the other hand, the Democrats got $369 billion in clean energy incentives in the Inflation Reduction Act. They left that intact. However, the extreme progressive Democrats are furious that it didn't go as far as making it easier to build interstate electrical transmission lines, which they're saying is a dire need for the spread of wind, solar, and renewable energies. There's a clawback on nearly $28 billion in COVID-19 relief funds, including money slated for highway infrastructures and strengthening the food supply. So there's some things there that are going on. Unemployment revamp. They were sending the COVID era funding, removed $1 billion that was supposed to help states revamp their creaky unemployment insurance systems. Those have become apparent. Congress originally provided $2 billion for the program. Take count of money that had already been obligated. Only about $500 million will be left. So, it'll be interesting to see the impact that might have on some states that obviously, they can't print money like the federal government. So they're obviously in a much more, they have balancing their budget is obviously much more important. I think one of the biggest ones, and we knew this was, we talked about this coming, student loan payments. They're coming back. It terminates the education department's suspension of federal loan and interest as of August 30th. It requires the administration to resume collecting monthly payments and charging interest for that's going to affect about 40 million Americans for the first time since 2020. And it had been continued to be extended based on executive action, twice by Trump, 6 times by the Biden administration. So this is definitely going to start hitting people, and I think that's important because we already know cash flow's tight. We know that people are struggling with mortgage payments and rent payments and higher utilities and other inflation. But now it's codified in law. There's going to be no further extensions to the delay on education loan payments. Now, obviously, this is political, but they're looking at around $5 billion a month is what they're saying that these payments were costing, and now it's going to all go. That's going to be a significant shift of revenue, but it's also going to eliminate the ability to cancel large swaths of debt. So if you were hoping for that, I think that you're probably going to be a little bit disappointed in the results there. There was let's see here on the other side of it. They wanted to permanently curtail the education department's authority to make changes to the student loan program. That is not the case. There's still a little bit of wiggle room for the executive, for executive control on that. So I think those are some of the big things that I'm reading from it. Some will hit you more directly than others, and I think the student loan probably, and unless you're extremely invested in the environmental discussion, which obviously has a significant impact, I think the student loan one is going to be the one that trickles down and hits directly to the majority of Americans.
Yeah, I mean, I've seen some of the statistics where it shows that credit card debt's going through the roof, and and with the student loan debt being restarted, I think it's going to be a real challenge for some of the younger generation. I don't know where this goes. I think it was kind of a political soapbox to stand up and say, hey, we're going to forgive a lot of student debt, and I think the reality is they can't do it in the way that they probably would like to, or the people would like to. I mean, certainly forgiving student loans that were, I don't want to say fraudulent, but let's just say inappropriately sold to people. You could probably argue, all right, those you could say, all right, you could forgive those because there's some people that got taken advantage of. But I think in general, like the idea of forgiving student loan, I want to bring this up as an idea, not a political topic, because I think people will make this political. But I bring it up in this way. I want to bring it up because I think a lot of people don't really understand is that when you have a loan, let's say I'm a student and I go to college and I borrow money to go to college. If I borrow, let's say $100,000 to go to college, where does that money come from? Well, that money comes from somebody who's lending it to me. Now, it could be an individual, it could be an institution, but someone out there has my loan as an asset. They took $100,000 of their own money. Like I said, whether it's an institution or an individual, it doesn't matter. Somebody out there took $100,000 and gave that to me so that I could pay for college. Okay. So it's a debt for me, but it's an asset for somebody else. Now, I kind of pose this situation because I want to play it forward another probably around 10 years where this is actually going to come into play, and it's not going to be student loans. So when you're forgiving a debt, effectively, either one of two things is happening. Either you're saying this debt's no longer valid, which means this other person who lent it to me is out $100,000. They lose $100,000 because they loaned it to me. Okay. Well, you could say, well, it's great, I can get rid of debt, but then somebody else, got harmed, right? They talk about this broken window fallacy, which economics say, oh, if somebody breaks a window, it causes a lot more economic activity. Yeah, but that's stupid, right? It's like saying, hey, if I throw a brick through a window, it means the window maker is going to make more money. And, it's like, yeah, but somewhere along the line, someone has to pay for that. There's no one in there that's not aggrieved in one way, shape, or form. Someone is in one way, shape, or form. So if you think about this situation, student debt, right? It's forgiven. Well, who pays? Well, it could be the government, right? And let's just say for the moment, it is the government who pays off that student loan. Okay, well, there's no aggrieved party, but yet every single American is aggrieved party because they lose $100,000 of taxpayer money that could have gone to something else like, defense spending, feeding homeless people, whatever it is, right? It doesn't matter. But the point is you're choosing that this is the best use of those funds. Now, I bring this up because I would say probably in about 10 years, when Social Security, Medicare, and pensions all run out of money right at the same time. And if you want to talk about a paradigm shift in the financial system in the U.S., that's going to be it. That's something I'm not immediately afraid about, but I'm definitely, let's put it on. I'm putting a thumbtack in the wall here for a time where if there's ever going to be an implosion in the financial system, it's going to be that. So if you think about what's going to have to happen if the whole world is hyper in debt, well in excess of what they can get out of, and some people argue that over 100% debt to GDP is a point where you can't come back from. Japan's well past that. We're past that. A few other countries are past that, and you could argue that that's going to be a big problem for the whole world. Well, if everybody's in debt, then the natural conclusion of that is what happened, hundreds and thousands of years ago, which is what they call a debt jubilee. Now, a debt jubilee is effectively, I forget what this started, but a debt jubilee is effectively where all debt is forgiven. All debt is forgiven, which basically means that if you borrowed a bunch of money, you don't owe it anymore. Now, you might think, oh, wow, that would be glorious. Yeah, but the implications are not, right? Because all the assets you own have some asset and some debt in there, right? If you have a 60-40 portfolio, 60% is equity, 40% is debt, which means fixed income is debt, by the way, for those of you who don't know. So if you have 40% of your portfolio in fixed income, that means 40% of your portfolio is going to disappear overnight, right? If it's forgiven. Let's just make the assumption that all debt is forgiven. That means you lose 40% of your portfolio. Now, I bring this up because we don't naturally think about the repercussions of our actions. It's the unintended consequences, if you will, right? So if you have a debt, if you have a mortgage, you might think, oh, glorious, I don't have a mortgage anymore and I have no more debt. Well, that's great, but then think of the implications, right? Let's just say all debt's forgiven. What would happen? Well, if I have $1 million home and I have no more mortgage, I can go out and get another mortgage and borrow $800,000, which means that I'm going to have a ton of money that I can spend and do whatever I want with that $800,000. The implications are going to be massive if that happens. However, I don't really see many other ways that we can get out of this mess without having something like that. So I'm not saying it's going to happen today, right? It's not. It's not going to happen today. It didn't happen with the debt ceiling, which we said it wouldn't. It's not going to happen next year. It's going to happen down the line because we can still kick the can down the road, and we're all very good at kicking the can down the road. So I bring this up because as we're talking about the debt ceiling, we're talking about, student loan forgiveness, all this, any sort of debt forgiveness means that somebody is going to pay the piper, whether it's us collectively because the government paid it off, or whether it's an individual because, it was forgiven, which means that you pretty much, lit the paper on fire. Now, what's funny is I actually made this prediction in 2008. I said, I wrote a letter to the Fed, and it's funny. I'll tell you the story. I don't think I've told this story on the podcast before, but it's a fun story. So in 2008, you all remember what happened? If you don't remember, please go read history. It's it's a lot of fun to read. But basically, the global financial system imploded, and they somehow found ways to put Humpty Dumpty back together again and make things working. But it was really close to completely imploding. I mean, it was, a day away in some cases from things completely falling apart. Now, that was bad. I've seen a lot of crises. That is worse than anything I've ever seen. Okay. And I haven't seen everything, but from what I've seen, that was the worst I've ever seen it for financial problems. Now looking at that situation, okay, we have, let's say, I just lost my train of thought, Doug. Can you help me out? Where was I going with this? Sorry, I'm a little spacey here. I got a little head cold. You there, Doug?
I'm here. I'm
Oh,
here.
yeah.
I'm trying to get you back on track, but I'm trying to think where you were going with that story. So
Oh,
this is
I remember the
yep.
Federal Reserve. Okay. So back then it was a mess. Okay. And the financial system was imploding. So I was actually reading Atlas Shrugged at the time, and I listened to it on tape like multiple times. Great book. If you never read it, it was perfect timing. That book, I think, was the most popular book sold during that period. And that book was, I don't know, 50, 60 years old, 70 years old at that time. And it was the most popular book sold. So if that tells you anything, I was not alone in thinking that this was a perfect time for this. Now, I bring this up because I was thinking about it. I was thinking, well, things are a mess. How do you solve this problem? Right? We all watch the news, and the news gives us solutions, and they're never the right solutions, but it's the ones that are given to us. We talk about it in the show how opinions are frequently given to you. But I was just thinking, all right, this is a problem that needs a solution. How would we solve it? Right? How could we solve this? Well, my solution was fairly simple. And I didn't know about jet jubilees at the time. This was just kind of off, out of ether. Found out after that that was actually a thing like hundreds of years ago. So basically, what my idea was that the Federal Reserve should buy up all the bad debt, all the junk, all the stuff that people were worried about. Buy it all up, right? Doesn't necessarily mean you have to pay top dollar, but buy it all up and then go in the backyard, put it in a big pile, and light it on fire. Which effectively you're forgiving the debt, right? But you think about who owned the debt, right, and who were the parties that were challenged by this. Well, there were some homeowners, there were definitely some financial institutions that were. Let's say on the edge of bankruptcy or were bankrupt and they were kind of allowed to mosey on, but we're talking about tons and tons and tons of bad debt, right? And the system was imploding. Now, you look back and you say that was a stupid idea. You say, well, at the time, it was the only idea that I'd heard of that was any good. Doesn't mean it was great, but it was something. So I thought about the idea. I said, why don't you just take all the bad debt, go out in the back and light it on fire? Basically, you're forgiving it. And I sent a letter to the Fed to this effect. I explained my whole idea and said, here's what I think you should do. And then no one responded. And no one responded. No one responded. So what did I do? I took the letter and I faxed it to every member of Congress, the president, the White House. I sent it to everybody, and then magically a week later, and by the way, I faxed it. I didn't mail it. I faxed it to everybody. So a week later, I get a letter from the Fed. Apparently, that worked because somebody saw it and somebody thought it was a good idea, and I got a letter back, and it was in typical Fed speak, as you might expect. It didn't make any sense. Maybe it made sense to them, but it didn't make sense to any common person who understands what's going on. And but I thought it was funny. And I saw there was a bill that was proposed to Congress to this effect a month later. Now it didn't go anywhere, and I wouldn't expect it would because by then things were picking up and people were kind of past that. But the point is I think a lot of us need to think outside the box for some of these challenges because you can't solve non-traditional problems with traditional solutions, right? Because if they were available, then they would have already been done by now. And we've pretty much exhausted all of the traditional solutions, and now we're just kind of waiting for the end of times to happen. And I don't know when it'll happen. Maybe it'll happen in 5 years, maybe it'll happen in 50 years. But eventually, with the path that we're taking on the US government, eventually we're going to run out of money, we're going to run out of credibility, and we're going to default on our debt eventually, right? It's inevitable because of the nature of finance. And it doesn't mean, like I said, it doesn't mean it's going to happen tomorrow. I know people are living in their bunker with their gold and their guns and their MREs thinking that, that the world's going to end tomorrow. It's not. It's not going to end tomorrow. If it does, it's not going to be because of the financial system, right? It's going to be because of something else. But it's not going to be a financial issue in the short term. But it is going to be a problem. It is inevitable. Numbers don't lie, people do. And so if you look at the numbers illustrate that eventually we're going to have a problem, just like every other country in the world that's experienced hyperinflation. At some point, we will too. Or globally, we will, which is probably more likely because we're not going to take it on alone. We're going to outsource some of it as well. So it's going to be a global problem. It's not going to be just the US, but it is going to be a problem. But I point this out because I think that everyone needs to understand that there are solutions. They're not solutions you're going to want to hear. They're not going to be solutions that are going to make you feel warm and fuzzy inside. But there are solutions to this challenge. And what that means is, and they talk about the global reset, which I think is a completely different thing, and I know it's been politicized, so I don't want to use that word. But effectively, what it is it's resetting all the financial systems in the world so people can start from scratch. That is what you call a debt jubilee. That has happened in history, and it is the most likely scenario to happen because the other ways you get out of this are inflation or default, right? And by default, I don't mean like I mean like you just decide not to pay your debt, right? Like what happened in the debt ceiling, people were claiming, oh, we just wouldn't pay. No, that would never happen. But you could do that. You could just say, sorry, I'm just not going to pay on that bond. Or you just have high inflation, which inflates away the value, which does solve the problem, but it actually steals from people in a subtle way, which is really what inflation is. It's theft. It's theft from the people. And economists can argue till they're blue in the face that, yeah, no, this is a good thing. And I'm not saying it's not a good thing as well, but it is theft from people, right? If you're a saver, if you've done a diligent job saving and investing your entire life, and now we don't have this today, but we were close to 10% inflation, we had 9%. And let's say that 9% stuck around for a while, you were not getting paid. You were not getting paid interest for that 9%. At the time it was 9, I think it was like 3% CDs. So you were losing 6% a year. So if you're a saver, that's terrible, right? If you don't have any money saved, you don't care. But then the other problem is now your goods and services cost 9% more, which means it's still affecting you. So inflation affects everybody. And unfortunately, our financial system is built on having a consistent low inflation. And if that doesn't happen, then we all get harmed by it, which is effectively what's going to happen in the next few years. Now, inflation's dropping, and let me come back to that because I want to give Doug a chance to talk because I do want to get into what's happening in the markets. But what are your thoughts here, Doug?
Well, I think going back to what you said, I think you're talking about inflation. I think, there's some arguments that the best way to deal with debt is through inflation because it's obviously, and that's kind of where, I think the Federal Reserve feels this. It does tend to deleverage debt with a more natural way, right? It doesn't necessarily, create choices of who gets their debt reduced. It slowly and just naturally kind of sucks a lot of those things out of the market. I think it also, but like you said, on the other hand, it discourages savings, right? It weakens capital formation. And I think the other thing you talked about early on is that debt is, if you understand how balance sheets work, debt and assets have to balance. So debt is an asset. And I think that, if you have a debt jubilee or something like that, it's really, some people will view this as an attack on property rights, and that would be really problematic for markets in disarray. It discouraged foreign investors. So I think we had a comment there about China not looking at this. I mean, there's a lot of investment in U.S. debt from the foreign, and all kinds of debt from foreign interest. And it certainly could discourage the purchase of assets in the United States. Then that will increase risk premiums on debt and equity capital. And then it also, there's the moral hazard issue that you talked about. If you can have just this debt disappear with no skin in the game, what does that do in terms of overall fiscal responsibility? I mean, obviously, we ran into that probably back in the early, the mid 2000s, with the first Great Recession. It was irresponsibility of how people were using their houses to just basically be a credit card. And I don't think that's not the issue today. Today, it's a lot more about trying to purchase a house prudently, but now having the price of housing be so exceptionally, high due to the low interest rates that we're running into an issue of just overextension in the budget and more of that, emotional need to have a house versus a fiscal balance of what's going to be truly the best for your cash flow. I think one of the biggest challenges I still have, with that sets student loan debt aside, is that it is, first of all, talk about the impact of just waiving all that. The federal government is now the direct lender of it. Now we still have private lending for student loans, but all of it is treated under a completely different methodology than any other debt. we have a system in the United States that allows people to go through the process of restructuring and bankruptcy, chapter 11, chapter 7, all sorts of different levels of bankruptcy that you can go through in order to try to get your debt under control. None of which applies now to student loans. If it's a private student loan, you can't get rid of it through bankruptcy, and you can't even get rid of it through death. Now that becomes a multi-generational problem. Federal student loans that are directly lent, you can get rid of those through debt or through death. I'm sorry, which certainly adds at least one relief from a multi-generational standpoint, but it's not subject to bankruptcy. The federal government is too invested in this. And while I know there was a comment about interest being generating money that can stimulate the economy, of course, it depends where that interest is going. If the interest is going to the federal government, there's arguments whether or not that stimulates the economy or not, especially if you believe in Keynesian economics, versus going to private interests. But of course, is that interest being recirculated? It's certainly a big question. And then you look at the destabilization of banks, right? We already have this problem, and we didn't even run into a situation of a debt jubilee, right? Right now, these banks are precariously leveraged in a way that we are still, having to come up with creative government approach to how these banks absolutely do have, an issue with the ability to be able to survive currently, based on everything that's going out there in terms of pressures. So I think the issue is it is absolutely treated completely differently. I think and yes, and we've got a great comment there that many private loan providers do now provide that forgiveness. Not necessarily by mandate, but it is certainly something that is coming into play, but isn't there for many of the student loans that were taken out years ago. And so I think if we're going to treat if we're going to look at debt, we have to look at debt in the way we've structured it, and make it equal, all debt being treated the same. And if we're going to have an exit strategy, then allow that exit strategy, which again, it's not free to go through bankruptcy. If anybody out there has gone through it, it's incredibly expensive. There's many barriers of entry to go through the process of getting through bankruptcy. So it does create a system in which, you have to really think hard and fast about whether or not you're going to go through that process, and not just, hey, let's just do it. Boom, it's gone. It's easy, right? And so there's already systems out there that make it difficult to go through it without just necessarily unilaterally just saying, hey, everybody, you're free, reset. Because I do think that between the issue of trust in assets and property rights, I think the moral hazard issue is obviously a very, very big deal when you have that type of situation. One thing that I do see, Kirk, that this is something to look at. There are rules in place that were put in place in order to kind of prevent very predatory medical debt type of scenarios. But it just came out here in Minnesota. We're starting to run into situations where these medical companies are going to start cracking down. Allina, who gets tons of tax incentives by being a nonprofit health system, just announced that they are now going to analyze medical debt before doing any medical treatment. Now, this does not apply to emergency services because we have rules that say everybody has to be treated under an emergency situation. But now they are going to prevent or restrict medical attention for non-emergency situations for anybody that has unpaid medical bills. And I believe the unpaid medical bill cap, and it looks like, believe, if I'm not mistaken on this, and I don't have it right in front of me, but I believe it's right around $3,500 or $4,500 unpaid debt. That's not a lot of debt to get for medical. I mean, I went and had a simple MRI and had a bill for, close to that, right? So that means the majority of people that have had that one major medical procedure out there may be cut off from any further medical care unless it's through an ER, which, and this is the other catch, a lot of health insurances have started to scrutinize. Blue Cross Blue Shield came into the press on this, have started to scrutinize allowing or paying health insurance for visits to the ER, because a lot of people were using the ER as their primary doctor, right? So they were trying to discourage people just go into the ER, and there's an entire industry that's been created in the medical community now where there's urgent care and then there's emergency care, and that's a whole different topic, but there has been a lot of emergency care facilities that have been created that look and mimic like urgent care. So a lot of people are using them as urgent care. And the insurance company said, sorry, you're cut off. So yes, there is unlimited treatment and emergency care services, but your insurance, if you have it, and many of these people don't, may not cover any of those services. But if you turn around with $3,500 or $4,500 in debt, you may not be able to get any further service from any other facility. This is something to watch, because one of the biggest debts out there, we talk about student loans, we talk about mortgages, but medical debt is massive.
Yeah, no, I appreciate you bringing that up, Doug. We're gonna kind of, in the interest of time, we're gonna talk about a few things that kind of cropped up this past week that I found some great charts and wanted to share them with you. And here, let me bring them up here. Here we go. So let's see. Technology is my friend. Technology is my friend. Here we go. All right.
Yeah. And by the way, speaking of technology, I think there's been a comment about my backdrop being reversed. This is a technology issue. It's supposed to be mirroring it, so I apologize. It's not that I'm just pasting backwards stuff there. Technology has always been a very interesting thing. Was we've run these podcasts, and if you've listened to them before, Kirk and I have joked about the ongoing joy of it.
Yes. So here we go. So I want to point out there's two charts here that I want to point out. And for those of you who are listening, I'll try to explain it. If not, to go to YouTube or LinkedIn and you'll be able to see this live. We'll also have the pictures on our website. So the first one is U.S. equity factoring. Now, basically what this means is a typical style. So the S&P 500 is a style. Then there's a S&P 500 growth, and then there's an S&P 500 value. And then there's high beta, and then there's buyback. So it's kind of like a style. You could argue whether it's actively managed. It's not actively managed traditionally, but these are what they call factor investing. And we have a panelist on the show that's really good at this. So I'll kind of bring this back at a later time to let him talk about it. But I did want to bring this up, and here's the reason. Okay, if you look at the indexes this year, it's a little deceiving as to what's actually going on. So the S&P 500, what this is looking at is excess returns, which means that whatever the return the S&P 500 is, it doesn't matter what it is, right? I think it's like, I don't know, it could be 8% or something like that. The Dow Jones is a lot less. But whatever it is, let's say it's 10%, just to make the numbers round, even though it's not 10, okay? What this is saying that the S&P 500 growth, so the growth stocks, are getting 14.3%. And it means that the high beta is getting 11.9%, right? Using 10 as the baseline. It also means that the S&P 500 value is getting 5.3%. And it means that the S&P 500 dividend aristocrats is negative 1.1%. And the S&P 500 low volatility, high dividend stocks is negative 8.9%. So we point this out because what is going on in the markets is so mind-boggling to people, because they're looking at the index and say, well, whatever, the index is up this. Say, yeah, but the index right now is composed 25% of the index. It might even be higher now. 25% of the index is 5 stocks. 5 stocks make up 25% of the index. That is, I believe right now it's at a historic high of individual stocks with a large makeup of the index. So whatever these 5 stocks are doing is impacting everything. And it's showing that everything else that doesn't have these 5 stocks is performing very poorly. So what's basically happening is you got 5 stocks driving the performance of the entire market. So you're like, oh, I'm doing great this year. Well, it's primarily because of 5 stocks. The rest of the market, if you look at this, is performing very poorly. because it's not keeping up. So low volatility, momentum, multi-factor, pure value, dividend aristocrats, buybacks, equal weight.
Eagle weight's the one that's telling to me, Kirk, because it obviously, instead of having that weighting, everything being equal, all 500 stocks in the S&P, look at that performance, negative 10%. It is being completely dragged down by the fact, and we do have a chart on that on the number of stocks that are weighted. It is just over 24, so not quite 25, but those 24 stocks or 24% of stocks are absolutely driving all the performance, and it's the equal weight is completely telling.
Yeah. So to what Doug was saying, so just for those of you who don't understand, so so there are ETFs out there, which are, if you think of like the S&P 500, right? Let's look at the ETF SPY, which is an ETF that tracks the S&P 500. There is also an ETF that tracks the S&P 500, but instead of the weighting, and the weighting would be each stock has a percentage, right? So there's 500 stocks. It's not like each one is 1/500th of the index. That would be the equal weight. Rather, it is a weighting based on market caps. The largest get the biggest weight, and the smallest get the smallest weight. Now, naturally, if you understand math, you realize the more money that goes into indexing, the more money that pushes into these large cap stocks. So the bigger continue to get bigger, right? And it means that, wow, these stocks are outperforming because they're a larger percentage and they keep getting bigger. And so more money drives in. It's a positive reinforcement loop. It's what we call reflexivity, as we've talked about in prior shows. So the reflexivity caused them to get bigger. Now, if you look at a different one, there is an equal weighted S&P 500, which as of this year, it's down, right? I'm looking at it right here. It started at right around 165. Right now it's trading at 143. So it's actually negative performance. Oh, I'm sorry, that was last year. Right now it is actually, I think as of today, it's positive 30 basis points. It's basically break even for the year. You might say, well, why is it break even for the year? The S&P 500 is up like, I don't know, what's up now, 8-10%. So if you look at this chart we're showing here, it shows that there's basically the NASDAQ, i.e. NVIDIA, which is basically outperformed because it is perceived as the AI company. And people want to invest in AI, and there's really like 2 or 3 companies that they can invest in. Well, that's one of them. Primarily, right now, the biggest weighting of the 5 stocks is, it shows here 24%, according to this chart. So where I'm going with this is understanding how the market is divided up. Now I'm going to show a different one here, which is, here's how it shows in comparison to every other asset class. So you have global infrastructure, and this is all based on the S&P 500. So month over month, year over year, everything is negative in comparison. Now, this should give you pause. And I think that's really what I want to point out here. It's not good or bad, not making excuses. I'm not saying that this is better than this. I'm just saying this is the kind of thing that we talk about in the show where something is out of place. You say, isn't that interesting? Well, here's a situation where you could say, isn't that interesting? What's going on here? Well, what's going on here is effectively that, as I said, there are 5 stocks basically manipulating the markets up. And it's not necessarily meaning that all of things are sunshines and rainbows. Okay. We have a handful of people have said this, and people like Elon Musk said this, and I don't put a lot of credibility into what Elon Musk says about finance. He's a very smart guy, right? And I don't want to take anything away from him. And he's probably a lot smarter than me. I mean, the guy's like borderline genius, but he's not a financial genius, right? So you can't. He named
this company Tesla for a reason. Tesla never cared about making money. He cared about innovation. Now, in this world, Elon Musk has made money, but let's face it, he is a risk taker, and it is not a fiscal decision when he makes
right.
When
so getting my point. So if you think of it like Warren Buffett, right? Warren Buffett's arguably one of the best investors of all time. I wouldn't go to him for political advice, and I wouldn't go to him for advice on green energy, right? That's not his strength, right? He's got strengths in certain areas, just like Elon Musk has strengths in certain areas. Doesn't mean he's a good investor. However, the point he raised is not something that other people have not raised. Like this is not a secret. Commercial real estate is in really bad shape, right? In LA, 30%, we found out a few weeks ago on a show, 30% of vacants, 30% of commercial real estate is vacant in LA. And LA is not the only place. There's a ton of vacancy. New York has a ton of vacancies in their commercial real estate. This is arguably one of the best, one of the next bubbles to pop. And for, I don't know why it hasn't imploded, but guess who owns that debt? Banks. So banks are not out of the woods by a long shot. This challenge they had with a handful of banks going down in the last few months, it's not necessarily over. And I'm not saying that they're all bad. I'm not saying that the financial system is going to implode. I'm just saying that this is a big problem, and it's not being talked about enough. And
Well, and I think Kirk, going to add on that, a lot of the commercial lending, more so than even maybe the private residential lending, is coming from regional banks. Right. So it's a lot of times, a lot of the commercial lending comes from banks in the local community. A lot of small business banks were started just to be able to provide that liquidity. And so we've already seen, where has the big problem been? Regional banks. And we haven't even started to go down the road of commercial lending yet.
right. So basically, if you're looking at if you're looking at these challenges and where they are, it should give you pause and say, huh, isn't that interesting? Now, arguably, the stock market could go up another 50%. It doesn't have to be rational. There's an old quote of, the stock market can remain irrational longer than we can remain solvent, right? So the market could keep going up, and it could make no sense. And all the institutional people I know are sitting on the sidelines saying, hey, I'm going to sit this one out because this is going to get uglier and uglier as it goes up. It doesn't mean it can't keep going up, and people are going to chase it, and people are going to lose money. So, and I'm
Look how long the markets continue to go up in back in 2007. I mean, we go out and watch The Big Short, right? They were saying, look, nothing smells right here, and yet it kept going up and up and
Yep.
up.
And I'm going to wrap it up here in the interest of time and give Doug a segue here. But I think that's an important point to recognize, is that all the stuff that's going on, just because it's going up, it doesn't mean it's good. Just because it's going down, it doesn't mean it's bad, right? The markets are typically 6 months ahead of where everybody else is. And inflation is probably going to keep dropping. And we've seen it drop. We're going to probably continue to see it drop. And then probably later on in the year, it's going to start to rise again. And that's normal. And that's what a lot of people are expecting, which means that the market can keep going up for a little while, and then it's probably going to fall apart, and it's going to fall apart in a bad way. But that is what you should expect, right? So don't jump in and say, all right, everything's good. Everything's safe. The water's safe. Everyone come on in. Doesn't necessarily mean that. So just keep that in mind with your investing style. Don't get lured in by rising stock market and assume everything's okay. If you want to gamble with it, great, go ahead and gamble with it. That's totally up to you. But just realize what you're doing, right? When you go to the casino, you don't go saying, hey, I'm going to make money today. Well, sure you do. Everybody says that. But deep down inside, you realize that I hope I'm lucky, right? Like that's you know that you're in a casino. You don't think you're in a sweeps what do they call those? I can't remember what they're called, but it's not, it's not a giveaway, right?
The sweepstakes?
Not the sweepstakes. I was thinking of like where you get the shopping cart, you fill it up with as much stuff as you can, and like.
Oh, like the grocery run. Yeah, those grocery run games.
Yeah, I forget what that was
where you go
called.
through it.
Yeah, that was a thing when I was a kid. Anyway, so I'm going to let you wrap it up here, Doug, and then I'll take us home. So, final thoughts from you.
Final thoughts on me. Again, we've got, good news is no panic. We're past the debt ceiling, whatever, good, bad it may be. We can move on from that, get that out of the news. Another thing to remind people, and again, another reason, look, markets can remain rational longer than you can remain solvent or patient, but also historically, the markets tend to be better historically, and this is a slight skew, the year before a presidential election. So I think, this is something to remember too, that is typically has been a bullish time frame. It doesn't mean that it will end up a bullish year. I went back and, Kirk, and looked at those numbers of the S&P 500 versus the equal weight. The S&P 500 year to date was about 12.5%. The equal weight was up about 1.8. But since February, The S&P 500 is up about 7%. Equal weight's down about 3.5%. Okay, so we've seen this massive shift since starting probably right around the end of first quarter, where I think you're starting to see those problems bubble up, and I think that's where you're starting to see the lesser 75% of the S&P 500 starting to show that it's under some significant stress. Okay, I like that you're showing what's going on with small caps. Small caps rely on domestic U.S. investment if they don't have global money coming in. So they tend to be a decent sign of what's going on in terms of the outlook of the U.S. economy. And the reality is there aren't that many public small companies. So you really want to know what's going on, start listening to the local community and listening to the chambers of commerce and listen to what small private businesses are going through right now. I can tell you, if you read the articles, they're starting to struggle. They're starting to get more pessimistic. They've been struggling with labor for a while. Now they're struggling with consumer spending. So I just think, again, the markets may be great, but understand that there's more to it than meets the eye. I want to thank you to Patrick, and it looks like we've got some other comments that have come in today. Thank you. It's always helpful to get those comments, and I know Patrick is involved in the college world, as am I. So it's great feedback, and appreciate the interaction there. I just want to say, speaking of that, and since to wrap this up with the time, if you want to learn more about it, again, if you're concerned, as Patrick said, 3 years of recent grads have never made a student loan payment. I want to say something about that, because that tends to suppress the understanding of what that impact is. Emotionally, they have never had to make a payment. And if they've never had to make a payment on it, this is going to create a much bigger emotional problem when all of a sudden they're paying for the first time. It's one thing to have been paying and get a little bit of relief. It's there. But if you came out of school and never had to pay, and now all of a sudden facing it for the first time, this is going to be a major fiscal, economic, and emotional impact. And I think, as we've seen in investing, Kirk, you would agree to this, emotions have a much, much bigger impact than almost anything else in terms of how you're going to handle your ability to deal with everything else going on in your life. So be aware of the impact of this. And again, if you don't want to get into that situation, if you want to create a great outcome and go to a wonderful college like I assume Patrick is part of, and get it in a way that's going to be a great outcome for you, but also not get into this debt crisis, learn what you need to know now. Doesn't matter how old your kid is, if you've just had a child, or more importantly, if you've got someone who's a freshman in high school to a senior in high school, get the information. Go check us out. Learn at procollegeplanners.com. And if you want to have a conversation and talk more about your own situation, reach out to us.
Great. Well, thanks, Doug. Once again, appreciate you on the show and sharing a lot of your wisdom with us. I know next week we're going to have another fun episode, and hopefully my head cold will be gone. So, but that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here in the show. Please remember to subscribe to the podcast on the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. So please send him a drone and help him express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.